In this week's market update, the Federal Reserve removes any doubts about its tightening path, and speculative technology stocks bear the brunt of the rate reset. The Federal Reserve's minutes don't normally set pulses racing. They tend to be a confirmation of what we already know. Last week's publication of the thinking behind December's Fed meeting, however, had an altogether bigger market impact. Investors were taken unawares by the US central bank's determination to get on with its tightening plans. The immediate impact was felt in the government bond market, where 10-year Treasury yields, which had ended last year at around 1.5%, rallied to 1.8%, as investors started to place bets that interest rates might start to rise as soon as March. The Fed had already indicated that it would be accelerating the reduction or taper in its bond purchases, but the tightening narrative ratcheted up a notch last week. The movement in nominal bond yields was also reflected in a rise in real yields, which reflect the gap between those nominal yields and the rate of inflation. In other words, for the first time in 4 years, real rates started to head higher in a meaningful way. It's real rates that really matter to the markets because they're the best indicator that the central bank is determined to squeeze the economy rather than simply follow growth and inflation expectations higher. Real bond yields have been bouncing around in a tight negative range for about a year now, as the Fed has held fire and investors have remained on the fence about whether the next tightening cycle is finally underway. Well, the answer to that question now seems clear. So the interesting question for investors now is, what does this mean for markets? And within those markets, who will be the likely winners and losers? The performance of the tech-heavy Nasdaq index last week provides one obvious answer. The Nasdaq shed around 4% in just the first 5 trading days of 2022, as investors abandoned fast-growing, but in some cases still unprofitable, tech companies and moved into the safety of more staid businesses. Also in the crosshairs were the highly profitable tech names like Google owner Alphabet and Apple, which have risen on the coattails of low interest rates, which make their high future earnings growth more valuable in today's money. The shift in Fed policy since the turn of the year is partly about the rise in inflation, which has been underway for several months now, but it also reflects growing confidence that the Omicron variant poses less of an existential threat to the reopening story than had been feared in the weeks before Christmas, when the highly transmissible nature of the strain raised concerns that even with a lower hospitalization rate, health services could be overwhelmed and governments would respond with strict lockdown measures. So the story for markets in 2022 really does look like being the road to interest rate normality. That narrative was given further support on Friday when US non-farm payroll jobs figures showed the American unemployment rate heading back below 4% on its way to revisiting the pre-pandemic low point of 3.5%. US household earnings also rose strongly, suggesting the Fed is right to worry about more persistent and widespread inflation. The drop-off in tech stocks raises the question once again about whether there will be a significant rotation from growth-focused shares back to cyclical value stocks. So far this year, the sectors most exposed to a reopening of the economy, such as banks, oil majors, airlines, and retail real estate stocks, have all advanced. The Russell 1000 Value Index has outperformed the equivalent growth marker by more than at any point since 1991. In another sign that investors are bracing themselves for a different market backdrop, riskier corners of the investment market, such as Bitcoin and so-called meme stocks, have had a bad few weeks. Bitcoin in particular has fallen from a high of nearly $70,000 to around $40,000 since the autumn. The idea that cryptocurrencies can be a store of value in a more inflationary environment will be tested by that kind of volatility and may encourage investors back into more traditional safe havens such as gold, which has recently been eclipsed by the new kid on the block. Gold has failed to deliver recently, and investors have seemed to abandon the precious metal in droves. Gold exchange-traded funds were hit by net outflows of $9 billion in 2021, That was the biggest withdrawal from gold funds since 2013. The gold price ended last year at around $1,800 an ounce, well down from its peak in the summer of 2020 of $2,067 an ounce. The outlook for gold is mixed, with some analysts pointing to further falls on the back of rising interest rates, which increase the opportunity cost of holding an asset which pays no income, while others see it resuming its long-term bull market on the back of increased demand for jewellery and a resumption of its safe haven status as geopolitical tensions rise in Ukraine, Kazakhstan and Taiwan. Turning back to the current week, things remain quiet on the data and earnings front. The highlight from an economic perspective will be a series of inflation releases around the world. Tuesday sees China, India, Russia and the US. And this last one is obviously the key figure to watch out for against the backdrop of the Fed minutes last week. The current expectation is that US CPI will top 7% in December. That's up from 6.8% in November, and it will be the biggest increase since February 1982, when the Fed was still battling to get on top of the rampant inflation of the 1970s. There are a few retail sales data announcements too, including the important US release on Friday. Here in the UK, we'll get the latest insight into the health of the UK economy in the period immediately before Omicron arrived to take the shine off the important year-end trading period. Friday's GDP release is expected to show a 0.5% increase in economic output between October and November last year. That would be a recovery from the near stagnation that was reported in October. And if that growth is confirmed, it will take the size of the UK economy back to where it was just before the pandemic struck in February 2020. That's the good news. Unfortunately, output is also forecast to have shrunk by as much as 0.8% in December, when Britain's self-imposed pre-Christmas lockdown took hold. Perhaps most importantly, however, from a market's perspective, will be at the start of the fourth quarter earnings season, with a handful of bank results due on Friday. Citigroup, JP Morgan Chase and Wells Fargo kick things off that day. Results of the last quarter of 2021 will be important as a guide to the pace at which earnings growth is likely to drop away through 2022. The current expectation is that growth will fall back from an annual rate of more than 40% to high single digits. That pace of earnings growth, while lower than during the pandemic recovery, would be enough to keep shares rising modestly as long as the pace of monetary tightening remains steady, inflation shows signs of peaking out in the summer, and stock market valuations stabilise at their current levels, having fallen back in some cases quite rapidly last year. Well, those are just a few of the bricks in the wall of worry that investors will be forced to scale this year.